This is the wrap-up for the live market open for Tuesday, March 1st. It's a new month, and the markets are positive mood. Thanks to yesterday's cut in the reserve requirement ratio, banks in China are allowed to lend more money, more credit, more economic activity, more global demand. Good mood. This probably came to mitigate PMIs, which were negative. Both fell below expectations. Also the government and also the official one, okay? But we also had soothing words from the US Treasury Secretary. He heard from the Chinese authorities that they will not devalue the yuan too much, that they're keeping their stability. More support from central banks. I mean, apart from the RR came from Bill Dudley of the New York Fed. That was slightly dovish. In general, we have a better market mood with oil moving higher. WTI at the 34 handle at the high end of the range. But data wasn't so good. I talked about the PMIs in China. Eurozone inflation missed. That's why euro-dollar is suffering a lot. Okay, minus 0.2 on the headline figure, which matters to the ECB year over year, and only 0.7 on the core. So no silver lining for the ECB. Bad figures also for the US. The Chicago PMI and pending home sales, and Australian rate decision did little to move markets. Today's figures, Eurozone manufacturing PMIs. So far, we had a disappointing one from Spain. We'll look at Italy. Soon, UK manufacturing PMI. Watch out for a negative surprise there. And in general, watch out for wild action before the release. Is it a leak? Is it front running? You never know. Of course, a few months ago, we had also a positive surprise. So anything is possible. More importantly, German unemployment change at 8.50, well, just after the show ends. Let's see if the positive trend continues. Again, it doesn't reflect what's really happening in the labor market, as we heard from Sinatra, but it's, of course, a market mover if we see the unemployment change continue dropping. Moving on, we have the Eurozone unemployment rate, a bit less important than the German one, expected to remain at 10.4. For those trading the Kiwi, we have the bi-weekly auction of milk prices. They fell 4 times in a row. Perhaps this time we'll have a bounce. And most important event for today, the ISM Manufacturing PMI in the United States, expected to bounce just a bit. Oh, again, I forgot the Canadian Canadian GDP, expected to be flat on the quarterly basis and monthly for December, small rise of 0.1. It could be a make or break point for the Canadian dollar. We'll soon show the chart. The ISM Manufacturing PMI, important as a first hint for the non-farm payrolls on Friday, expected to rise from 48.2 to 48.5. I will not be surprised if it falls below 48, because the manufacturing sector does not look good in the United States, nor in the Eurozone, nor in China, nor well, everywhere. Okay. Also, Italy's PMI disappointed, by the way, 52.2 instead of 52.5. So just strengthening what I said. Okay, and yeah, GDP in Australia. I think we didn't miss anything. Now let's look at the charts. More interesting. Euro dollar. Pressure to the downside range between 108.50 to 109.60. Further support 107.70 and further resistance 110.80. German unemployment, Eurozone unemployment to watch. For the pound, it's moving higher. Let's talk about Brexit. Perhaps some hopes for the manufacturing PMI in the UK. 140 is resistance, 138.40 support. Dollar yen, better market move. Well, it's breaking above 113.20. Stronger dollar and, more importantly, weaker yen, because there is no demand for a safe haven. 114 is resistance. 111 is very, very, very strong support. Dollar CAD currently 135.10. Critical support at 134.60, which was a double top, and now we're getting close to this line. Okay, GDP could be a make or break. Aussie dollar relatively higher thanks to the better market mood. Nothing from the RBA, and ignoring the Chinese figures. But happy with the Chinese cut of the RRR, and the Kiwi dollar ahead of milk prices. The past hour falling a bit, but in general higher within the 65.50 to 67 range. Okay, before we go, I